Hey investors, welcome back to another episode. A poor man's covered call is a strategy where you generate income without the upfront investment normally associated with covered calls because you do not have to actually buy the expensive underlying stock. The poor man's covered call is also known as a diagonal debit spread or a diagonal call spread, and regardless of the name, just remember that it lowers the upfront cost by replacing a long stock position with a long in-the-money call option so we can deliver the stock if necessary. So instead of having to buy 100 shares of an expensive stock like Amazon, you replace the stock position with a much more affordable option. In this video, we'll be going over the poor man's covered call cheat sheet so you'll have an example to follow when placing your orders. What are the main benefits of a poor man's covered call? Number one is limited risk. Number two, low capital required compared to a traditional covered call. Number three, it's very cost effective. And number four, it's used to play a bullish direction. Today's video is a cheat sheet to make sure you set up your poor man's covered call correctly, and as a cheat sheet, it will be short and to the point. If you like my style of teaching and you want to see more videos like this, be sure to subscribe, give it a thumbs up, and share it with your friends and family. I'll be using a real example from Thinkorswim to demonstrate how to place a poor man's covered call, and if you are using another platform, it may look a little different, but the structure is the same. The main thing is to know which call options you want to buy and sell when you're putting together your diagonal option order, and I have everything covered for you in the cheat sheet. All right, now's the time to grab a huge cup of coffee and hang on, because this is not your normal stock channel. Our goal with a poor man's covered call is to generate income by simulating a covered call using options. And technically, this is called a long call diagonal debit spread, and we use this to replicate a covered call position. This strategy gets its name because of the reduced risk and capital requirement compared to a traditional covered call. Let's go through an example using ExxonMobil, which at the time of this video is trading at $72.17. We want to buy one in-the-money call option, and this is going to have a longer-term expiration date, and we want to sell one out-of-the-money call option, and this is going to have a near-term or closer expiration date. So right here we can see this is our current price, and we're looking at this using Thinkorswim, and for our option change, our closer term is the 18 February. We want to sell the $85 call, and we can see this right down here on our order with the spread. And then we want to buy the March 18th $60 call, and then we can see that on our order, and this is the way we set up this order. And with this, we're going to have a maximum profit of $1,261. Our maximum loss will be $1,239. Our break even is $72.34, and the delta on this option is going to be 82.1. When do we profit? When the price of the underlying stock rises above the upper break-even point. This is a very basic bullish strategy where we profit from the stock going up. Now, a poor man's covered call, the strategy is a diagonal spread because the two options have different expiration dates and prices, meaning they're located diagonally on an options chain. It's a debit strategy because the two options create a net debit, meaning you'll have to pay money to start the position. The maximum profit potential of a covered call is achieved if the stock price is at or above the strike price of the call at expiration. Now, we want to consider closing if we reach 50% profits or more, although this is really up to you, and that's just a rough guideline that I like to use. And for our maximum loss, it's equal to the total net debit we paid to start the position. And if we happen to be in a losing trade because the stock price is decreasing, the short call can be rolled to a lower strike to collect more credit. And here are a few tips for trading poor man covered calls. Number one, choose stocks that have low or decreasing implied volatility. Ideally, we want the implied volatility to be lower than the stock price. Number two, avoid companies that have near-term earnings reports or other events that could increase volatility. Number three, we want to choose long in-the-money call options with an extrinsic value equal to or less than the short option. In general, we want to look to sell a call with a 70 delta or higher. The more in the money, the easier it will be to find opportunities. Number five, we want to focus on quality calls that you would want to own where it is likely that the price is going to go up. And number six, if the stock price moves significantly higher, take your profits because there is now less profit potential. And now let's do a quick walkthrough while looking at our charts. Here we're in Thinkorswim. We can see we're looking at ExxonMobil. The first thing we notice at the top, I've got the TOS bar, and that just tells us everything is green and that the stock's been going up very nicely. And if we look at the chart here, it's been going up very nicely recently. Next, we've got our 20-day moving average. I love it whenever the stock is over that. And then this yellow line, this is our implied volatility. And remember, we like to have the stock price above the implied implied volatility whenever possible. So now let's jump over into our option screen. We simply click on trade, boom, it pulls up the option screen. Here is our order summary. We're going to buy one of the March 18th at 60, and we're going to sell the February 18th at 85. So here is our 85, and if we hover over it, it will tell us to sell. And then here is our 60, and if we hover over it, it'll tell us which one is the buy and which one is the sell. And all we have to do now is click confirm and send, and then we have done a poor man's covered call. I really hope you enjoyed this video. If you have any questions, let me know in the comment section down below. And if you made it this far, have a wonderful day. Smash that like button and subscribe if you haven't already. Thank you so much for watching, and I'll see you on the next video.